All right, welcome everyone. Welcome to the Hurley Investments last week of February market view commentary. This is Monday evening, the 22nd of February. I'm going to answer some questions because someone asked me some questions here that I want to go over with you guys on what I'm doing and why. First of all, last night, poor Kiev. If you guys can give Kiev some love next time he's on teaching one of these, he needs it. In the middle of the night, and just take a quick peek. This says right here, 2:03 a.m. last night, I'm texting Kiev, Boeing calls for global grounding of 777s with one engine model. But here I am at 2 o'clock in the morning sending him stuff. 6:37, our market opens up at 7:30. We're going to get crushed today. Boeing and Baidu down big today along with everything else. I guess we get puts on, right? And it was a little bit of a test. Let's face it, I didn't know if we should or we shouldn't. But my comment was, Boeing and Baidu down big today along with everything else. Guess we get puts on, right? Or do we wait the first hour and see if it comes back like it had every other day this year? It's so interesting to me how many people don't ever learn from past history. Boy, we almost had it today. If Baidu had held its gains, we almost would have had a day like last Friday. Today, Hurley Investments was down $2,428. Not bad on a 0.77. If I was to do the math on what we should have been down, 17,602, 856 times 0.77, $135,541.99. That's what we should have been down. We're only down 2,428. I can't believe I missed this from Friday. Down almost 0.2%. Code Investments was up roughly 2%. Hurley Investments was even better. We were up almost 400. Well, we were 400 and like $400,600. And I didn't take a picture of it. But what happens sometimes is through the night, it's about 2 o'clock in the morning, I'm checking the futures for Europe as they open up. And sometimes if the futures in Europe look bad or Europe is down, I end up staying up and I end up spending my time finding out what's going on, and it's a bummer. That's the best way to say it. It's a bummer. And if they open up bad like last night, the futures last night looked horrible in Europe across the board. The DAX was down like 0.6, the FTSE was down 0.1%, and the CAC was down like 0.97. So as I was looking at last night's futures, I'm up in the morning, I'm trying to figure out what has changed. The narrative right now for Hurley Investments, we're mostly stock ready to take some profits out of leap calls, but we're mostly stock weathering the bumps in the storm because we think stimulus will shoot us up another 3 to 5% before we have a drop. Kevin, isn't that a pretty big risk? Well, not if you understand history and what it did to us last year. The stimulus had us bounce out of a pretty bad bear market. Are you going to remember history and understand how to apply history to the stock market? So, are we taking a chance? Yes. We're letting some things run right now that may seem risky, but we have some great returns in our market because of it. Is it worthwhile? I think so. In fact, earlier today with Baidu up at 354, again, we were up another $340,000. Kevin, the question was asked to me recently, Kevin, what about a recession? And it's funny because the estimate for Thursday for the GDP is 4.1. We're expected growth for the quarter at 4.1. I don't think we're heading for a recession. I just don't see it. Kevin, do you know there's like 118,000 deaths under Biden's watch? He was 25% or 33% of all of Trump's deaths in the first 2 months he's been in office. And I kind of scratch my head because I don't understand where that rationale affects our stock market. I don't even know how to verify those numbers. So what do? I guess you go from January 21st when Biden took over, and then all the deaths are his responsibility. It's a freaking pandemic. I can't stand the guy, but to pin all those deaths on him, it's a pandemic. It's not a person's fault. We are doing a good job. He seems to be continuing the rollout of the vaccine shots. If you listen to Fox News and Bloomberg's jumping on board, there's a belief that we may have herd immunity as early as the end of May. Dr. Gupta and Maude, if you're here, please comment on what you guys think, if that makes sense. I'm not sure those numbers add up to me. I still think it's out in August of next year. And I would hate to see, and no, it would not be Biden's fault, as much as I dislike the gentleman, if we got one more burst, one more, hey, we pass it around, and then numbers start to come down. I think you will see a little bit of overconfidence in people thinking that the vaccine is out there and that enough people in May are vaccinated that off they go. A lot of that is based on an assumed number of people that have already had it. And again, if you understand what assume means, just look at the way that it's spelled. ASS space U space ME. I don't think it's a smart idea to assume anything, whether it's positive or negative. When it comes to the coronavirus, you just look at the facts and they talk to you. I have one of the doctors with us that said, let's hope so. But mathematically, it just, to make that assumption seems not smart. I wouldn't assume anything. I would let the numbers go for themselves. I believe Fauci said that maybe this fall for herd immunity, but we need to keep an eye on the variant strains. Thank you for adding that in there as well. Again, it seems like August. Mathematically, if we keep increasing on the numbers that we are and have the amount of vaccinations, it looks like August. But again, some news outlets are saying, oh, we're going to have it in May. The question is, do the Democrats need the fear of not getting herd immunity so it justifies the relief bill, the $1.9 trillion relief bill? If we are going to have herd immunity as early as May, is that bill needed? And how much of that bill goes to the U.S.? How much goes overseas? It'll be very interesting to see. As I did my mathematical calculations, as I told everyone, a while ago, my thought is I'm thinking we're out till August, and that's just crunching numbers. Boeing had a problem with one of their planes. It's an engine manufacturer. It's not GE. It threw a fan blade. That is scary, but the good news is that most planes can fly on just one engine. And I'm going to do a quick check. I should have done it before. I wonder how often fan blades throw a blade. I should have done that. I was going to look at that ahead of time, but I don't know. I wouldn't think it's going to affect Boeing long term. A day or two, it's a buying opportunity and come back. So a couple people asked me a couple weeks ago, and I got this question today as well. So Kevin, the question was asked, how do we match with the S&P 500 on up and down days? Right? That's the question. Hey, if the S&P is up, how do you match? If the S&P is down, how do you match? It was pretty amazing because on Friday we beat the S&P by 2.5%. Today we basically beat the S&P by 0.75%. That's 3.25%. But it really comes down to this. So this is a simple answer. It really comes down to this. If we are off by 0.5%, then I look to see if we are over leveraged or under leveraged. It's that simple. If we are, I may take a look and I may consider lightening up on a position. I may consider adding protection to a position. I may not do anything at all. There's no set hard rule. For example, a year ago, when Boeing had their problems, a year and a half ago, I just did the math. I looked at how much they had in their pipeline for positions, airplanes on orders, government contracts, and so forth. It was pretty simple for me to see, hey, we're sitting well with Boeing. Boeing was an opportunity to get into the position. So, with that said, it was an opportunity for some of us. It's how would I say it? I knew it would throw off the overall total. I knew it might throw off some accounts, but there wasn't an action to take other than add some long puts and take advantage of the situation. Someone asked me today, oh my gosh, have you seen Baidu? My answer is I'm up at 2 o'clock in the morning for a quick check on futures. We are literally watching so you don't have to. That's our job. Steve and I are watching the market so that you guys don't have to. In doing so, of course I've seen what Baidu's done. It hit 354 today. Well, Kevin, it finished down. Have you seen the after hours? It's horrible. How can you just be letting it go? Well, I'm just letting it go because it's technically not really overbought. When it is overbought, it can stay overbought for weeks, if not a month on end. And the reality is, it's Baidu. I've justified it. If you take the last 3 years of earnings that were excellent, mathematically, it can go up to 455 on the high side and 437 on the low side. Kevin, how did you come up with those numbers? All I did is added up their earnings that they didn't get credit for, ran it out for evaluation against their earnings per share, which also should be a little bit higher, and mathematically you come up with a range between 437 and 455. That's why I chose 450 for our short call strike price. I also looked at the credit. But the reason we're at 450, whether you're January 23s or the January 22s, wherever those are hidden at in all these, it wasn't just by choice. It's a mathematical equation. Hey, in the next year on the current PE, you can justify Baidu being somewhere between 437 and 455. Well, Kevin, you have some of these out to January 23. So I'm giving 2 years for a standard 1-year PEG ratio because it might take 2 years with the big run we've already had. Kevin, what are you going to do if all of a sudden Baidu shoots above 450? Well, I'll probably create this same $22 to $25 spread to capture from 450 to 550. Some of these are risk-free. Some of these are 250, 450s. You're getting paid to try to make a ridiculous return. So going back, the second question that was asked, how do you decide to take long? How do you decide to take long put profits and convert them to shares? I'm looking for support levels. It really has nothing to do with if you can pick up 100 shares. It does not make any sense. If Bank of America were to fall and were to fall to this pivot point, to automatically convert those to shares. Well, Kevin, why not? Because last time it hit the pivot point, it fell through, and the 50-day was the support. Well, what if it bounces off the pivot point and starts to head back up? Then I might miss collecting a full 100 shares that are paid for. I might only get 90 or 88 or 86 or 75. But I'm looking for opportunities at support levels. I know a 50-day simple moving average is much stronger than a pivot point. If you noticed, we took off put protection on that first red line down day. We had an up day, we had 2 that sucked, and then it took off. A lot of people asked, how did you know? We didn't know. All we knew is we took a chance and it finished right on the 50-day simple moving average. For 3 days, we stressed. And then it took off and we gained a 20% gain after adding 100 shares the end of January. Kevin, do you really stress? Well, I'll tell you what. If you don't understand that I'm bugging an employee via text at 2:03 in the morning, I don't think you understand the job. My money's in with you guys. I'm at that 5 days before, 5 days after. I've got to trade right along with you. We have a retirement account. You guys don't get to see that all the time. I can show my little personal money one. I stress just as much as you guys. What's even worse is my wife stresses probably 10 times the amount I do. One of the interesting things with what we do is, again, plain and simple, you guys have heard me say this a million times. What we do is a repeatable process that dollar costs averages your shares without asking for more money to be put into the account. We make our best educated guesses, and when we are wrong, we usually have protection to make the wrongs a right. That's it. You want a mission statement for Hurley Investments? What we do is a repeatable process, the collar trade. The collar trade is or can be long stock, a long put, and a short call. You can have one of those positions in play and still be in a collar trade. You do not have to have all three at the same time. You are not smart if you keep all three on the same time. You're overpaying and giving away all your profits to protection. In real life, if you want to make money, you use a repeatable process that rewards you for making up some of the downward movement. I should put that in here, right? That makes up some of the downward movement to dollar cost average your shares without asking for more money to be put into the account. Instead of just lowering the cost basis, we're looking for that exponential growth. We make our best educated guesses. When we're wrong, it's not 100% of the time, but we usually have protection on to make the wrongs a right. One of the neat things about what we do, sometimes we are in risk-free trades. How cool is it sometimes to have stock ownership, add a long put, and for a 2 or 3 month period of time, you're not at risk at losing any money. Your initial capital is protected, is a better way to say it. It's not necessarily true to say that you're not at risk at losing any money. You're not at risk at losing your initial capital. That's why we do what we do. It's the new normal since 2008, which means you've got to stop doing the same old crap. With that said, let me show you guys a couple things. 3 CE credits and a free Peloton, right? So I double click on this. Hey, on March 17th, you can go to this great conference, half-day conference. I'll get 3 hours of continuing education credits. I'm required to do 24 hours every 2 years. I could win a brand new Peloton because we need to learn about tomorrow's global portfolio and the outlook for international ETFs. The ESG advantage, the emerging sustaining investing, looking beyond a 60-40 model, making fixed income work in the real world, right? That's the crap they're going to tell me. That's what I get to go through and register and pay some money for. What garbage? Because in real life, if you go to the simple Bloomberg, hey, 5 things to start your day with, Bloomberg said it as clear as day. So anyone that's trying to put you into some 20 or 60-40 garbage, I get this every single day. The Bloomberg 5 things to start your day. Yields breakout. Market reflationists are winning the day as bond yields spike from Australia to the U.S. A key part of the Treasuries curve, the gap between the 5 and 30-year yields, I always thought it was a 7 and 30, by the way, touched the highest level in more than 6 years. There are real-life indications of price pressures to back up the market moves. Figures last week show U.S. retail sales surging and U.K. prices picking up. Both nations are moving fast with vaccines. Even in Europe, the prospect of inflation is being entertained. It is a bad time to be a bond bull. HSBC strategist Steve Major and Lawrence Dreyer abandoned their recommendation to buy U.S. long bonds, saying they cannot ignore the reinflation trade, even as they remain skeptical of it. What they're trying to say in plain English is rates are going to go much higher. As rates go much higher, the bonds you purchased 3 to 5 years ago stay in play. They're no longer traded. They're no longer going to be callable. They lock you into a crappy rate for a long period of time, and the value of the bonds goes down because they're not as attractable. That's not, what's the word? They're not as attractive as these higher bonds are. They become untradeable. And literally, if you're going to get out of them, you're going to take a 10, 15, 20% loss. Is your money manager correct in saying, hey, if you stay in it for 10 years, you don't lose a penny? He is correct in saying that. Is he wrong in not telling you your bonds aren't keeping up with inflation? Damn right he is. He's wrong. It's something he should have told you. I've warned people about this. Bonds are not where you need to be. I showed you guys a couple weeks ago on the Hurley Investments exponential returns. If you're getting stuck at 3 or 4% on 40% of your portfolio and the stock market's up 14.44%, 16%, you're never going to beat the S&P 500. It's the dumbest damn growth model ever invented on the face of God's green earth. Yet people are putting people into people. Stockbrokers, registered investment advisors are putting people into 60-40 models all the damn time. It's like Walmart has struck a deal with Wall Street so that they can have an unlimited supply of Walmart greeters because people aren't making it in their portfolios to have them grow enough to be able to retire on. All right, here we go. I'm off my soapbox. Where will the market stand this week? I'm going to say up, so it'll probably be down. Last week was flat to slightly up, which was nice. Nope, it was down. It was down for the week, down 0.5%. But we're still just hovering. What I'm really paying attention to are two things. On the Dow, we're still hovering above being overbought, and we are overbought with big money. So for these 31 companies on the Dow, not really anything that a money manager follows. It's just for TV. Anytime you hear someone talking about the Dow, there's your first red flag that they're full of crap and don't know what they're talking about. We don't use the Dow as a benchmark. It's a traditional index. It's reported on, but nobody benchmarks any type of portfolio against the Dow. It is not an important index. S&P 500, big difference. We're just coming down to either a bounce line or a bearish line. And we have that on two of the indicators. and we're undecided on the MACD, technically we are still bullish, but it's uncertain. The next couple days will be the tell on where our market goes, whether it's going to be higher or lower. And then on the flip side, on the NASDAQ, which you obviously compared to the NASDAQ and the S&P all the time, huge down day today, crossing over negative, conflicting. We're oversold by big money, but the MACD, the weighting of the index against itself, we're bearish. So technically, today's the first day, maybe tomorrow's the second day. We might technically be bearish on the NASDAQ. I'm going to say we're probably getting a bounce. We're probably getting a bounce and heading back higher. It'll be on stimulus, any stimulus news. Off we go to the upside. All right. Still going to say 2% ending in February. Earnings, we're coming back to the first week of retail sales. We have Crocs, Home Depot, Macy's, Dillard's, Square. On Tuesday, we had MRO, Marathon Oil today. Cheniere Energy on Wednesday, Lowe's, Office Depot, Six Flags Magic Mountain, TJ Maxx, L Brands, Nvidia. That'll be one to pay attention to. Vivint. AES on Thursday, Best Buy, Domino's Pizza, Dollar Tree, Nettie's. Dell is on Thursday with First Solar, Hewlett Packard, Monster Drinks. Foot Locker on Friday. Pretty interesting day coming up to see where things might move to. I'm going to get that question here in just a minute. Economic reports, leading indicators were today. Nice to see it up. Really, Thursday and Friday are the big days. Thursday with durable goods, GDP, and not pending home sales. That's going to be pending home sales. And then Friday, personal income, personal spending, Michigan sentiment. Those could move markets. Again, I did not do any research internationally. International news at this time just doesn't matter. It's where the U.S. is going to be. 5 things to start your day. Just wanted to have this in here for the yields. You're welcome to read the rest of it, but the yields I found interesting. I don't read the Joe's Morning, but gold and Bitcoin, blah, just a bunch of garbage. Disney Prime for success. I found it interesting. Someone asked me today, how did you know? Well, in all honesty, it's not how did I know. The comment is plain and simple. Disney for me is expected to be somewhere between 196 and 203. So I'm letting a bullish stock run. Did I know it was going to go up $8 today or $9 today? No, but after its earnings, it has a run to 196 to 203. Someone came out with a price on Disney that was kind of ridiculous because they're giving Disney Netflix numbers right now. They don't have Netflix numbers. They have Netflix content, kind of, but nothing new. So when I saw the upgrade on Disney and the what am I trying to say? The expected 12-month growth on it, it doesn't add up. You can't give Disney Netflix numbers and returns and number of clients yet. It just doesn't work that way. But you got some dumb analyst that's pushing it. You've got to understand how dumb analysts are. Don't blindly follow an analyst, but work your own numbers to see if they're correct. I did like this article. I liked where it could go to. It was something that I wanted to show you guys so you can see why I'm looking at Disney. Really interesting to find out that multiple bundles can happen. Pretty cool to check out their numbers, and I like where it's going. New $1,400 stimulus checks could be coming. What we know and how soon they may arrive. I just threw this in here so you know who's going to get it, how much you're going to get, blah, 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 blah. Some Texans use the Ford 2021 hybrid pickup trucks to power their homes amid the winter storm. Pretty cool that the new Ford pickup trucks, especially the hybrid ones, have a mobile generator in the back of their bed. Man, do I want a new Ford truck. My truck has 267,000 miles on it. I need a new Ford truck. This is the one that I want. Pretty dang cool. Death toll hits $500,000 in the U.S. as vaccinations race virus. If you take 500,000 and divide it by 350 million, it makes the virus seem very unimportant. And in the big scope of things, and I'm probably going to have both Maud and Dr. Gupta that'll kick me upside the head. In the big scope of things, I obviously don't want anyone to die or anyone to suffer a death in a family, a friend. I get it. It's horrific. But when you take 500,000 and divide it by 350 million, in the scope of the population growth, the risk of the population, a pandemic wiping out half the population like pandemics in the past, meaning early 1900s, Spanish flu, Black Plague kind of things, we're nowhere close to it. I wish I had never said in the past it's just the flu. But mathematically, it's less than just the flu or pneumonia. It doesn't mean that I don't feel for those who have lost someone. It's awful. It probably or might have been preventable, but it didn't justify a 28% drop in our market. And then the market doesn't justify like a 48, 50% run up from the lows. Maybe 100% run up from the lows, right? 21 something to 39. We have a market that is not correctly pricing in a pandemic. I also believe, I'm going to go on a limb in saying it, I kind of think some of those deaths that we started out with, so I'm not going to say who said it, but there's been a couple comments that have come in. How many of those deaths are comorbidity, right? How many of them died because of diabetes or gunshot wounds or car accidents that may have tested positive for the Wuhan because the government was giving out $75,000 to those hospitals? Our market is out of whack. We can probably see one more really good year because the comps are low, but we're going to have challenges. Tax selling, possibly a flare-up one more time, summer doldrums, new taxes going into effect next year, which will exacerbate a sell-off this year. Someone made the comment, if big money is moving out of big tech, where's it going to go? Probably back into big tech. Kevin, can't it go into oil? Maybe. Maybe not. We'll see how long it takes for them to understand a Keystone pipeline and refining more oil creates jobs. It's kind of good for a country to be energy efficient. I don't see where big money truly will be running out of technology. They'll just sell off, wait for it to drop down as people sell off, and buy back in. We have this ever running up higher in our stock market. We continue to melt up. And it's something that got us through this morning, is allowing the market to continue to melt up. Are there any other questions you guys have that I can answer for you? While you guys are typing questions, I want to show you one other thing I thought was rather funny. I got another email. Hey, you're invited to a multifamily investment during COVID-19 webinar. What will people do in California to make money in investing in a multifamily investment during COVID-19 strategy? Are we talking about rental properties again and rental units? Probably so. But I just found it really, I kind of giggled. I thought, what a joke. What a joke. All right. Yes, a comment was made. Depends how much money Warren Buffett donates to the Democrats. Then there's no pipeline. 57, million, 58 million. Cut that off so we could ship oil again one more time through United Pacific railroads that he owns. Pretty interesting. All right, guys. Hey, I don't see any questions coming across. I've got another webinar and call to get on here in 12 minutes. I appreciate you guys being with me here tonight. Thank you for attending this webinar. I hope this information is helpful for you, that you can see how we're thinking, see what we're looking at, see the time and effort that we put into managing your money, protecting your money, and making our best educated decisions based on the information we have in front of us. Guys, have a good night. I appreciate you being here, and I'll see you again next week. Good night.